Good evening, everyone. Thank you for tuning in to this financial Q&A, which is the last of the sessions that we're doing before the summer break. For those of you that don't know me, my name is Nick Sherrill-Ambus, and I'm joined by my colleague, Cliona O'Donoghue. We're going to spend the next 30 minutes just going through some of the questions that we've received over the last few weeks, covering all aspects of personal finance, and typically just helping you to get your money working harder. We'd like to try and keep these sessions relatively informal, so please do feel free to put any questions that you have into the chat box. Cliona will address those, and it's going to be a kind of a quick fire, as I say, answering questions. So please do get as much out of it as you can. Just before we kick into the questions, I just wanted to run through very briefly, for those of you that wouldn't be too familiar with Alpha Wealth, we're a financial services company, Cork-centric. There's currently 8 advisors. You can see myself and Cliona in the screen there. And we provide personal financial advice to individuals, covering areas such as mortgages, savings accounts, getting the most out of your money, planning for retirement, and also covering all aspects of insurances. And really the main purpose, I suppose, that we're trying to get across today is that you should be looking to get advice in any area that you need some support or assistance or guidance with, without feeling any obligation to do any business with anyone. One of the things that we are offering this evening is a review, which we're reducing by 50% up until the end of June. So for a full financial review, the cost is €99 plus VAT, and that incorporates projections that we'll do for you, independent assessment of your pension situation, and helping you in many areas. And that's a one-off fee for any future ongoing consultations that we provide. So just to talk very briefly in respect of where we find ourselves, and the main aspect really for everyone is that, as we're all familiar, unfortunately, we're having a scenario where banks are not paying any interest, and yet we're suffering inflation rates of circa 5–6% per year. And that means that the value of your savings, whether it's in the bank, in the post office, is really eroding, and we need to try and see what we can do to try and ensure that that doesn't happen. And we're going to cover off some aspects of that. Just to give you a heads up, the next webinar that we'll be doing in September is how to save €30,000. And this is just a very quick snippet of how we help clients really start to formulate a plan to try and build up money for either deposit for a property, to save for a car, for a wedding, or other personal aspect of finance that they're looking to do. And again, you can see some figures there on the screen in terms of how much it will cost over what period, on a basis of a return of about 3.5% after fees and taxes. And that's something that we're going to give some support to and help people understand how they can really get their money working harder. This is a very quick example of the types of savings plans that we offer our clients. We set up the Alpha Wealth Savings and Investment Club last year. It's been hugely successful, as an entry level of €100 per month, providing returns over the last number of years in this account of 5 to 6%, which we feel is very, very doable, and certainly something that we'd like to be able to share more information with you. And certainly we can provide it to anyone who's listening, either live or indeed if you are listening to this on playback, please feel free to reach out to us. We can do that. This quick graphic just shows, for any parents out there who are looking to save the child allowance, how they can build up a fairly significant sum of money by starting early. You can see here for the amount of 140 a month, over a period of 5, 12, and 18 years, the types of amounts that could be generated. But again, this is assuming a growth of 3.5%, which is the basis growth that we use. Just before Cliona comes in, I just want to talk very briefly about a tax-backed scheme, and it's called the EIIS scheme, or the Employment Investment Incentive Scheme. Now, I'm only just going to give you a quick headline on it this evening, but for those of you that are not familiar with it, who are suffering tax at the higher rate, it is an opportunity to get 40% back from the taxman on a 4-year contribution into the scheme. Again, we can provide information to you, and as an independent broker, we have no bias in this. And again, it's explaining to you how this scheme can work favorably. Finally, just in terms of the areas that I've mentioned, covering things like mortgage advice, independent protection reviews, planning for your retirement, succession and estate planning, child savings, and also tax-backed savings schemes. So what I'd like to do now is just invite Cliona, and Cliona's going to go through the next 25 minutes of questions, which I'll answer. But please do ask any questions in the chat box. If anyone would like to ask any questions at the end, by all means, feel free to do so. We wanted to make sure that you get the most from this. So
thanks, Nick. These are questions that have come in over the last 2 weeks. So the first one is, I have 10,000 euros to invest. What do you advise?
It really depends on what your current situation looks like in terms of any loans that you might have. Obviously, if you've got any credit cards, they'll be typically the first things that we'd encourage you to pay off. Have you sufficiently funded your pension? Because that's a very tax-effective vehicle. But in relation to savings and putting money away for this medium-term segue of 3 to 15 years, there is a really good option, which I've alluded to earlier, which is within the insurance companies that gives you this return of investment. So really, the answer to the question is making sure that you have the correct balance of short, medium, and long-term savings, and helping you find what are the right vehicles within that.
What are the best ways that you would suggest to reduce tax?
Pensions are a very attractive way for anyone who's paying tax at the higher rate. And I say to them, and some people have become a little bit skeptical of pensions, particularly given the fact that we've seen a bit of a fall in pension values over the last few months. But if you think about it, for every €1,000 that you put into a pension scheme, you typically get relief at 40%. If you're a lower rate taxpayer, 20%. But the money grows tax-free between now and when you draw down that benefit from any age from 60 onwards. And at the end of that period, you get 25% of that tax-free from the government. I think it's a really, really powerful tool for people, and I do think it's underutilized. The EIS scheme that I mentioned earlier is also another really attractive scheme, and they're really the two ways in which I think people can mitigate the tax they pay.
Would you recommend saving for a home extension or taking out a loan to finance it?
I would strongly recommend that if people can avoid taking out loans, apart from a mortgage, mortgages are the cheapest form of finance. It's much better now. That doesn't always work in the real world. And I had a conversation with clients today who had money in the credit union, but had a credit union loan and it was offset against. And I was just trying to explain to them the fact that they were basically giving their money to the bank and borrowing it back from them and paying interest for the privilege. So the short answer to the question is, again, if you can plan appropriately in that short, medium, and long-term segue, it should give you the ability, hopefully, to avoid taking out those loans. And the 30,000, webinar that I mentioned earlier, I think is a really good tool to kind of listen to get access to that.
I am leaving a public sector job for the private sector. How would you suggest I manage my pension?
There's a bit of guidance and advice needed when it comes to transitioning from public to private, or indeed private to public sector. And what I'd like to invite you to do is do go onto our Linktree on Instagram, reach out to myself, nick@alphawealth.ie, and book in for a consultation. And for €99 plus that, you get a full comprehensive review, and we'll give you some independent guidance in terms of how to get an assessment of where you are currently and what your best options are in terms of whatever arrangements you have.
So the next question is around a lump sum. So this person has said, I sold a property recently and have a lump sum. Should I invest it or should I pay off my mortgage?
Again, there's no hard and fast answer here. And whatever I say financially may not necessarily sit well with the individual. Some people don't like carrying debt. But I think it's about a balance. And what we're trying to do really is try and help people find what the right balance is. If you have, let's say, an investment property mortgage and you're paying rates of circa 5%, typically my advice would be to try and pay off a fair chunk of that. But if you've recently fixed on a green mortgage, for example, or a low rate through the likes of Avant or ICS at 2%, I'd be more inclined to maybe use that money towards your pension. So again, it depends really on where you find yourself.
Okay. In relation to KBC accounts, so I have a current and deposit account with KBC. Where should I transfer this? And is it easy to transfer all money and direct debits to a new bank?
As we all know, KBC and Ulster Bank are leaving the Irish marketplace. It was thought that it was going to be made simple in terms of the process of them giving you a switcher into another institution. Unfortunately, that doesn't seem to be the case. They are entitled to write to you and give you 6 months notice of when the accounts will close. Even if you haven't received a letter, I would encourage you strongly to set up a new account. I have no preference here specifically, and I say to people, maybe use a bank that's close to you if you want to use, I suppose an in-person presence. I personally set up an account with Bank of Ireland because they have a branch in Little Island, and I find it just useful if I ever need to use them, go into them. Bank of Ireland have made the process a little bit easier, but if you prefer to use Revolut, if you like online banking, then use them. There's no real advantage or disadvantage to any institution at the moment. It's just a case of getting yourself moved, and moving on to direct debits should be fairly straightforward once you have that done. And again, we can assist you with that if you'd like.
This question is in relation to children's allowance. So this person has said that they've been saving the children's allowance into the credit union, but is there any better long-term account that you would suggest?
As a parent of 4 children myself, I feel very strongly about making sure that we're making our money work harder for us. And the issue I have at the moment with the bank, post office and credit union is that they pay no interest. The good thing about these alternatives that I mentioned, and Zurich have a really, really good savings plan for children primarily, but also for adults. And again, going back to what I said earlier about this 3-year plus segue of monies that you might have. So obviously, if you have young children, you would typically qualify. And the longer you save for, the more advantageous these accounts are. But getting the compounded effect of growth on these accounts is enormous, even at a relatively low rate. So to answer the question, the Zurich Easy Access account, which we've set up under the guise of the Alpha Savings and Investment Club, is by far the best product of its type. There's no entry costs, there's no exit penalties. You can get out of it at any stage, and it will make significantly more than a bank account will over a period of 3 years plus, in my opinion.
So in terms of mortgages, where is the best mortgage rate at the moment if looking to get on the property ladder?
I would always encourage people to use a mortgage broker. Whilst we give mortgage advice, we're not biased and we don't specifically provide mortgages. And it depends, again, on your circumstances. So, for example, depending on your loan-to-value ratio, i.e. how much of a deposit you have, whether it's an existing property or whether it's cash that you've generated, it will depend on what type of bank. The most important thing is not the bank, it's about the rate of interest. And anyone who has a mortgage currently, I would strongly encourage you to find out what the cost of your mortgage is on an annual basis. And if it's more than 2.25%, and if it's likely to come to its expiry in the next 24 months, you should absolutely get onto that bank, find out the cost of refixing at a lower rate, because the problem is that a lot of us are going to find that by the time we reach the end of our fixed term expiry next year or the year after, rates would have gone up typically by about 1%. So the short of the answer is get down to 2.25, reach out to me, I can help you with that. Feel free to message me. I can give you some very quick guidance and advice with no cost to give that to you at this stage. And it's a case of getting down to that rate and fixing for 5 years or longer. And if you have an energy efficient home, you should be entitled to a green mortgage, which will easily entitle you to that rate over that 5-year period.
So we have a question in here, with world markets expecting a recession, would you recommend a lump sum investment now or partial sums to investment over the year?
I'm a great believer of the way to make money from investments is give them time. So it's a time in, not trying to time the market. Now, markets perform very well in general since COVID. Some insurance companies outperformed others, and this is where I suppose talking to an independent broker would be useful. But I would suggest if you have money that's earning little or no interest in the bank, you should look to invest it. Just make sure you invest it in a vehicle that has the appropriate risk for what you feel comfortable with. The longer you invest for, typically the more risk you should accept, and then it's at a low fee. So I would suggest that if you had a lump sum of monies, yes, invest it. Suggesting that we're coming to a recession, markets are very efficient and they will have priced this in. And typically the pullback that we've seen recently has taken into account all of those factors. They generally tend to be forward thinking. So I think now is a good opportunity in comparison to, say, 6 months ago, of course. And I would like to think that these investment managers would certainly be able to navigate making sure that they're in the most appropriate investments to do the best for clients. The example I give you is during COVID, a lot of the companies would have bought the stay-at-home type stocks that did extremely well, the likes of Amazon, Google, and so on. And they got out of them late last year before the recent pullback that we've seen with the tech companies.
This is a question that comes in kind of quite regularly. I'm spending a lot of money monthly and can't seem to save. Would you have any advice on this, or what would you suggest?
And it can be very difficult, okay? And I'm very pragmatic in the fact that, you know, we all have various different financial challenges, from trying to, you know, pay for our kids' schooling and, you know, everything else ancillary that goes with that. We have a financial budgeter. It's on our Instagram page. You know, you can download it. There's no cost to that. And it's also on our website. Or indeed, we can provide that to you. If you reach out to me, I'll send it to you immediately. It's a really good tool to use. I suggest that everyone does it once a year. It'll focus your mind on what you spend your money on and help you visualize where savings can be made. Feel free to send it back to me and I'll give you some tips as to how you can reduce some of the outgoings that you have. Quick examples are like the likes of health insurance. A lot of us pay for, not many of us gets discounts on. It's knowing how to navigate the market. Getting kids free on health insurance. So I've only ever paid for one child and got the others free, for example. Massive savings, which we can certainly get for you. But these are things that I think will help people's financial position in order to help you save.
So another question around, it's coming on, I'm getting a bonus soon, and should I use the money to repay debt or use some to top up my emergency fund?
Some financial advisors have this kind of rule of thumb that you should have 3 to 6 months of your salary in an emergency fund. I don't personally subscribe to that. I've never had that amount in a bank earning nothing for me. And look, we can all worry about the unforeseen, but my general rule of thumb is no more than 1 month's salary, and that's net salary, and because it earns no interest. And keep your money liquid, but that's actually got the ability to grow. So the example I used earlier of the Zurich account, you can invest a lump sum into, and you can get access to it if the emergency happens. So it's a really great way of having kind of the best of both worlds.
So now on to kind of life insurance. So what are your thoughts on life insurance, and do you feel that it is necessary to have life insurance?
It's an important financial tool, especially for people who have dependents. And obviously it's a legal obligation if you have a home of which you've taken out a mortgage for. The problem I have with life insurance is that most financial advisors sell on fear. You know, when I was, you know, starting out with the banks, we were told to sell 10 times someone's salary for life insurance, regardless of their other circumstances. What I would say is that, again, someone who has dependents themselves, it's making sure that you're paying the lowest amount for the life insurance that you have, knowing that there are 3 different things that you can insure for: your income, for example, and also for serious illness. And I've said earlier, and I'm going to repeat this, that we need to find the right balance. There's no point having Udo's amount of life insurance and not ensuring that your income is protected. And a lot of us may actually be overinsured because a lot of us don't realize, but you know, we're part of companies that will have quite generous benefits. So the first thing I would say to everyone on the call is, if you are working for a company that provides you a pension, it's quite likely that they provide death in service, and they will pay for a certain period of your income if you're out of work. And you should find that out really before you embark on trying to get advice around taking out life insurance. And it can be obtained quite cheaply as well, by the way. So I'm worried that a lot of people are paying like 50, 100 euros a month for mortgage protection or life insurance. I wouldn't dream of paying anywhere near that. You know, 25 euros a month for non-smokers is as much as I'd ever pay. Smoking, unfortunately, adds 7 years to your life. I would encourage any smokers, if they could, stop for 12 months, take out life assurance and start smoking again if they are inclined to, because the cost will go down significantly if they do. But other than that, you really shouldn't be paying too much for it. It's not a product that costs a lot of money.
And then in relation to income protection, can you have more than one income protection policy? And are they both valid if the worst happens?
Yes, you can have more than one income protection policy, but you shouldn't typically. And the second thing is, yes, they can pay out, but you can only be 75% of your income if you're out of work through illness or sickness. So anyone, let's say, who's earning 50,000 a year, they can only insure up to 35,000, and that takes off the statutory sick pay of 12,000 a year. So you can only insure for about half of your income on that basis. I think it's a product that makes sense for some people, especially if there's only one person in the household working and they have no benefits through their employment. But like everything, it's about getting information about what these things cost and making an informed decision. And I say to people, just explore it without any obligation or bias. I was talking to someone earlier again today who said that they were dealing with one of the insurance companies and they were pushing them very hard to take out income protection without really asking too much about their partner situation in terms of their benefits that they had, or indeed finding out if they actually had any cover in the first place.
This was kind of, I suppose, in the press last week around, is it necessary now to have health insurance? What would your thoughts on this be?
Anyone who's under 35 years of age in good health, I'm not convinced that it makes sense for you to pay for health insurance. It's an expensive product. Typically, the cost for an adult is around 870 euros a year for a decent policy. You can pay less, but I wouldn't. And then people can pay anything up to 3,000 if they're not careful. The reason I say under 35 is that when you turn 35 years of age, a levy kicks in. It's 2% per year that you are above 35. So for example, if someone doesn't have health insurance and waits until they're 40 to take out health insurance, they're going to pay 5 by 2%, which is 10% a year for every year for the rest of their lives. So all I'd say is be mindful of your health. And if there's a particular reason why you feel that you should take out health insurance, but from 35 onwards, yes, I think it makes sense. And again, going back to what I said earlier about ensuring that you have the right plan at a discount and that you're certainly not paying for more than one child. But again, reach out to me. I can give you, tips, show you how to navigate, the plans. There's 480 plans in the market, and make sure that you're not overpaying for it, because you can change intra-year. A lot of people think that because they have health insurance with VHI, they have to stay with them, or they're in the middle of a plan with Leia that they can't change the plan we're with, and that's completely incorrect.
So then kind of on to a few questions just around pensions. The first is, if you leave your job, should you carry over your pension plan?
It really depends. I say to anyone that leaves an employment where they had a pension scheme, there's really 3 options. One of them is that you leave it where it is, which I'm not really a big fan of. People don't really realize what's going on with it. Nobody manages it for them. The other option is to move it into your new employer, but you have to check with your new employer that they'll take in the transfer. And it's not always the best thing to do, but it is an option. And the third is where you move the money into a standalone, what's called a pension bond, which is basically moving the money where somebody manages it. Again, Alpha Wealth in this example would provide that type of bond. And one of the advantages of that is it gives you access to that money from age 50 onwards, which doesn't mean that you should take it at 50, but it's nice to know what options you have. Some clients have worked for various different companies, and it allows them then to take the monies at different times where they might need the money. But again, it's really about getting the advice, and the important thing, in my opinion, is to talk to an independent broker and find out what the best options are before you do anything.
So on that then, how much would you suggest I put into a pension on a monthly basis?
My rule of thumb is 10% of your salary gross. So anyone who's earning 50,000 a year, I would suggest considering putting 5,000 a year of that, which that might seem like a lot to some people, but given that you get 40% tax relief if you're earning 50,000, because you'll be a high rate taxpayer, it'll only cost you 3,000 a year, which is 250 a month. And I think that's proportionate to how much you earn. Now, if you're in the privileged position of having a company to pay for it, then you're even better again, and that'll help you then retire early. It depends on what stage you start at, and the key thing for pensions is start early, guys. Anyone who has the ability to start at 30 should. If you're 40 something and you don't have many provisions, it's not to be worried about. It's just to be aware of the fact that you can make up time and get some proper planning in place. And that's something that we always tell our clients. How much do you have currently in your pensions? And most importantly is, where are you targeting? What's the roadmap look like? And where are you aiming for? And I say this to everyone, you should have a target in mind. Are you looking to retire at 60? And when I say retire, I'm talking about being financially independent. You don't have to work beyond that date. You may choose to, and many people want to, but it's about being able to do something different, either change employment, work part-time. Who knows what could happen? They may lose their job. They may get made redundant from one of the pharma companies. They may have ill health, and it's about planning appropriately so that you don't have to rely on having to work in your later years.
So you mentioned the age 60 there for retirement. This question is there a lower limit age that you can retire and start drawing down on a pension fund? Or is it just a matter of if you exceed the thresholds that you pay tax on the amount you draw down over that?
A lot of people think that you can't retire before you're 65. That's a misnomer. You can retire typically any age from 60 onwards. There is access to some pensions, as I said earlier, at 50. The state benefit currently doesn't kick in until 66, which is paid in addition to that for people that have the sufficient PRSI contributions made, which for most people, if they work 30 years or more, will have. Again, it's really about what you're looking to try and achieve. So there's no hard and fast rule. In terms of the tax that you pay, that's typically at the standard rate. So I use the example of 800,000 in the pension fund. Many people ask me, like, what should you have in your pension? And I say, well, if you can target a figure of 800,000, that's the sweet spot. It enables you to take the maximum amount tax-free, which is 200,000 euros, and the balance of that 60,000, you can draw sufficient income, in my opinion, for the rest of your life and leave a sum behind you to your partner, spouse, or indeed your children.
So in relation to AVCs, this person wants to know, it's again around getting a bonus. Should they put their bonus, or would you suggest putting their bonus into AVCs or into shares?
It partly depends on their age. I like having that balance between AVCs and shares. Shares are suitable, but I don't like people building up too much money in shares. And anyone who is in a position where they do receive shares from their company or are able to purchase shares, they should be looking to sell them when they vest and keep buying them. There's advantages to them doing that. But also, shares are risky. I mean, we've seen there Amazon has fallen 40% over the last 6 months. Kerry Group, which was a company that people were saying was kind of bulletproof, has fallen over 17% since the start of the year. So to answer the question, it's really a balance. If you haven't paid into AVCs, I would suggest that you might consider that. But if you're looking at achieving, shorter term financial goals, then shares may be the way to go. So it's a case of finding that balance again.
Okay. And in relation to cryptocurrencies, which is obviously very topical again at the moment, if I want to invest in cryptocurrencies, how much would you suggest putting in, and to which coins?
Cryptocurrencies are very risky. I've said this many times before. I have exposure to cryptocurrencies and I've invested over the years, and I have some good and bad experiences. Be very careful of scams. Be mindful of, why are you investing? Is it to speculate? Are you trying to make a quick win because it's a fear of missing out? It is an asset class, and the answer to the question is certainly no more than 5% of your investable portfolio. So if you have 10,000 euros to invest, I would invest no more than 5% of that. It wouldn't deem well. It's too risky an asset class, and I prefer for you to put your money into solid instruments like the Zurich account that I mentioned, like your pension, that are more diversified and that can weather storms better than a cryptocurrency can.
That's really it, Nick, with the questions. But I suppose if anybody else would like to pop something into the Q&A function or the chat function, we'd be more than happy to ask the question. But maybe just while we're waiting, I don't know, is there any kind of one tip that you would give, over the next few months with inflation and everything like that? Is there anything that you'd kind of say to the people that have dialed in as a tip? Or
Yeah, I'd just like to say, firstly, thank you to those of you that are on the call again this evening or listening back to this. And I know there's a few of you that have been on many of these webinars. And if it's not this evening, please do ask any questions. We want to be able to interact with people and give them guidance in whatever area it might be, however trivial. The key takeaways, I suppose, for this evening, guys, are that there are alternatives to the banks. Some of you may have them already, and I say to you, just do you know kind of what fees you're paying? Because you might have the right instrument, but it's the wrong plan. You may have bought it too expensively, you may be charged excessively for it, and it may not be appropriately invested. So the key thing is just to review your situation. Now, not a lot of people perceive there to be a lot of hassle. The fact that you've taken the time to listen to this suggests to me that you're at least interested in trying to do more or better for yourselves. Make sure that you know where you are. Get Alpha Wealth or your own broker to review your situation and give you some guidance. Don't be afraid of the noise that you hear out there. It isn't always applicable to you. And make sure that you know what you have and whether there are other options or alternatives to you. And the main thing is just give things time. People are talking at the moment about some of the headwinds that we may face. I appreciate it's a difficult time for anyone who's saving for a mortgage, for example. And I say to them, get battle ready, get the mortgage approval, be in a position where you can, I suppose, act appropriately, and don't sit back and sort of wait, because unfortunately that's not always going to be the best, way to go forward.
Nick, there's a question in here just around something that you mentioned in relation to health insurance and paying for just one child. And I think maybe a little bit of confusion. Why would you suggest just paying for one child?
Because some of the companies provide plans where you pay for one child and get all the others free. So I use Leia, and I've only ever paid for one plan. And these are good plans. Like the Essential Health Family is a really comprehensive plan. Kids' health insurance is really cheap. I only pay €250 for the plan every year, and I get all of the kids covered. It's a no-brainer, guys. And I feel sorry for any parents who are paying for more than one child, not knowing that there are offers, but you need to know how to navigate them because they're only available at certain times of the year. It generally tends to be around January, the quiet times during the summer, and then late on in the year. But even if your renewal dates are not falling within that, you can manipulate the system where you basically renew until such a time that these offers become available. But anyone who, and that person who asked the question, email me and I'll tell you exactly what the plans look like. You can Google it on the websites. Leia, for example, just type in free child Leia and it'll show you that, and we can help you select the right plan.
I think you've clarified that. They've said thank you.
Thank you.
Another question is, are there any industries that you would avoid investing by purchasing share stocks, and any that you would ensure is in your portfolio?
It's a really good question. And it's one that, whilst I'm not one to sit on the fence, I'd be very wary of trying to pick the next win, or indeed, industries that I would avoid. I prefer to give the expert investment managers that are doing this day to day the guidance to be able to do that. So typically the funds that we select are diversified, but they give the investment manager the ability to navigate. So as I said earlier, the tech stocks have performed terribly so far this year. I wouldn't plow into tech stocks for that reason. I'd rather the investment managers do, because the example I give you is that ethical investing was a really big topic last year, and it's gone off the radar because a lot of the ethical funds have suffered terribly because people unfortunately are not prepared to pay the extra cost that's entitled when things are hard. So it's a really good question, but again, I can give you some tips and guidance around what I would suggest are the best funds, but they're going to be very diversified, selected by the different managers, the likes of Goodbody, Zurich, and so on.
I think that's it with all the questions that we've had in. So thank you very much for dialing into the webinar this evening.
Great, and thank you very much, everyone. And as I say, if anyone is interested in getting some more information, or indeed does want to book in for a financial review, please email me, nick@alphawealth.ie. Go onto our website, you can get our contact details, or our Instagram. Really appreciate the support, and I hope you got something from this evening. And as I said, we will be doing a follow-up webinar in September on how to generate 30,000 euros. It's going to be really interesting for anyone, so please do get on to me and I can send you the details for that, and we'll keep in touch. And I hope you have a great rest of the week, and hopefully we'll be speaking to you soon. Take care.